What impact is continuing market volatility and low liquidity having on transitions, particularly equity transitions? And how are you working with clients to help overcome these challenges?
Yeah, there's two different types of volatility really in the marketplace. There's the volatility that's driven by news events, or crisis type volatility where lots of volume comes into the markets and we see a lot of whipsawing of prices. And then there's the volatility that's brought on by now, for instance, volatility is generally pretty low in the marketplace, but you can have volatility within a specific event, a specific transition event or specific trading, because the demand is exceeding the supply out there. So low volatility but low volume periods, individual trades can drive volatility. So we look to differentiate the volatility for those two types of events. When we were back in crisis days, it was very high volume, so it was actually a good time for trading from a cost perspective, as long as you tightly manage the risk elements within a trade. Right now, the volatility is low, so you still have a risk management process that you go through, but it's easier to tighten down the tracking error between the buy and the sell side, or the legacy and the target portfolio. But what you have to do is moderate the trade flow as you're going through on the actual trading itself. So you're testing the waters and easing back. Well, we might start in on a trade going in at 10% of participation rate in the daily volumes and ease our way up to 20%, only to find the two portfolios starting to diverge. And then we have to ease back off and down to 12, 15, 12, 10, and find our spot every day. So in high volume periods, you can kind of depend on the past volume patterns and the past volumes in the market to dictate how fast you're going to go. In these sort of summer volumes, as this is more indicative of summer than anything else, you have to really kind of test the water in an iterative back and forth and be a very high touch process.
The need for transparency and clear pricing remain recurring themes in the transition management business. Why? What are your clients' expectations in this regard?
The why is all about the difference between a traditional trading type business and a transition management business. So if you're an asset manager and your buy-side trading desk is putting out orders to a sell-side trader, there's this interaction that happens all the time. If you're a plan sponsor who's saying, please restructure from these portfolios to those portfolios, oftentimes it could be weeks before you come back and say, here's how we did. And there is this vast, or I guess absence of interactivity during that process that makes people wonder, well, what happened on that day, or what happened in this market? It's trying to bring those clients more interaction during the transition event to give them the information that they're looking for, to get that transparency in pricing, to get that transparency in process. So what we do is we will get interactive conversations going live with our transition managers as we're doing it in those markets, if that's what our clients want to do. We also, since we own the infrastructure, we can go back and recreate all of the information that somebody wants at a moment's notice. It's we own it, we have it, and so it's readily available for us. But it's really all about getting more interaction, or at least the ability to have, for clients to have interaction during this extended period of time, instead of having that gulf of absence of information during that period.
The transition management service set is being expanded. What are the drivers of this change?
It's really all about our platform, right? So we have this platform that we developed for transition management years ago, and that platform is something where it's where a client can come to us kind of a one-stop shop. They can bring us anything, equities, fixed income, FX, derivatives, whatever it is. We have this multi-asset class global platform that we built to service transitions. But the reality is, as it's evolved over time, clients have given us more to do and more solutions that are needed, and it's evolved over time to deal with monitoring of their daily exposures relative to their investment policy statements, looking at the disparity of their asset class weights or their style tilts relative to their investment policy statements. And so from that kind of grew an overlay business. So that we're, instead of just doing transition management or periodic restructures, we're also doing that in the middle of those restructures, the monitoring and measurement and the management of those exposures along the way. From that, we've also started to look at other client sets that are looking at the same sorts of things. They're saying, really my focus is managing this portfolio, and my specialty is not in building a multi-asset class global trading structure, but yours is. So maybe you should do all of this for us and help us with these sorts of issues. So it's really all about the platform. It's not about the transition management business striving to diversify into many different product streams. It's really about leveraging this one platform and finding ways to use it that attracts different clients to us.